So good evening, students. Very good evening to you, all of you. Radha, Kanaya, good evening, good evening. Radha, that was about which particular this thing?
Sir, capital gains notes.
The first thing. Okay, anyways, any case, Radha, what you can do is that students, for the capital gains, like the last session, we discussed which section? Primarily, if you see the definition of transfer, you can just take a note of it, all of you. The definition of transfer, the definition of capital asset. And then, students, we also discussed the charging section, isn't it? There was a general charge from section 67.1 that we all discussed. The general charge under section 67.1 students that we all discussed. We already have written, students, what is the general charge? Students, what is the general charge? The general charge was in the head capital gains, the section 67, subsection 1.
Progress.
The exclusion to the definition of capital asset, will that be applicable? And the answer is no. Why? Exclusion is restricted only in respect of movable personal effect. And not only that, students, in that exclusion also, students, we have seen that there is exclusion out of the exclusions. Like certain personal effect, namely like jewelry, work of art, sculpture, paintings, drawings. These are the items which are excluded from that exclusion of movable personal effect. So if they're excluded from the exclusion of movable personal effect, what does it mean, students? It means they are included in the definition of capital asset. They are included in the definition of capital asset. That is what we have seen, isn't it? And that exactly is the part. Apart from that, students, we have also seen that the capital asset includes, there is specific inclusion given, and one important inclusion, students, that they've given is security which are held by the foreign institutional investors. So if the securities which are held by the foreign institutional investor, students, then that is always considered as what? As a capital asset. Now you're not supposed to ask any further question that, sir, but the foreign institutional investor, the volume of the transaction is too large. The frequency of the transaction is also very high or very frequent. So it appears that the securities which are held by the foreign institutional investors, these securities are considered as a stock in trade. That may be an impression that you may get looking into the volume, looking into the frequency. But what I told you, if there is a specific particular item included in the definition of capital asset, that the securities which are held by the FII will be considered as a capital asset, then it will put all the controversy to rest. It will put all the controversy to rest. Now you are not supposed to argue further. Is that one clear to all of you, students? Definition of capital asset clear? We then move to the definition of transfer, students. We then move to the definition of transfer. Now, in the definition of transfer, students, there are normal particular clauses and then there are some special clauses which are there. In the normal clauses that we have seen, students, in the normal clauses, students, that we have seen, they are what, students? Point number one: sales, exchange, extinguishment, relinquishment, isn't it? These are certain normal particular cases. And then thereafter, students, there are some special case like conversion of capital asset into stock in trade. That is also a transfer, isn't it? Apart from that, students, even a compulsory acquisition by law, even a compulsory acquisition by law, is that a transfer? And the answer is yes. And there are a couple of more special case of transfer, students, but that I will take you all through in a separate discussion when I do taxation of real estate transactions at that point of time. There are some couple of special cases of transfer. Okay. So sales, exchange, relinquishment, extinguishment of rights. Thereafter, conversion of capital asset into stock in trade. In that context, then thereafter the compulsory acquisition by law. In this regard, so these are some of the special cases of the term, of the definition of term transfer, students. Of the definition of the term transfer. And after this, students, after this, then I took you through in the last class the cases of the specific charge. And I gave you those particular examples. If you see the general charge, students, the general charge is in respect of the transfer of a capital asset. And such transfer of capital asset which results into a capital gain, then that capital gains will be charged in which tax year? In the tax year in which the transfer has taken place. Then I took you through to certain cases. Students, I took you through to certain cases where what? Where technically speaking, students, technically speaking, the transfer has taken place. But the tax year of chargeability is not the tax year of transfer. The tax year of chargeability is not the tax year of transfer. Then what is the tax year? In this case, I gave you two particular cases. Which is the two cases? One is the conversion of capital asset into stock in trade, and another is the compulsory acquisition by law. Now, in these two particular cases, students, what do you all get? In these two particular cases, students, what do you all get? Tell me. That these two cases are very much covered in the definition of transfer. So technically speaking, the chargeability should also be attracted in the tax year of such transfer, that is the tax year of conversion, or the tax year of what? Of compulsory acquisition by law. That become because they are the tax year of transfer. But in practical, do we charge in that particular tax year? Answer is no. And in which tax year then we charge? Students, in which tax year we charge? In the subsequent period. And those case studies are known to all of you. Tell me, for the first case, which case? The conversion of capital asset into stock in trade. Which is the tax year in which the chargeability is attracted? Tell me quickly, students. I'm asking the question and you need to keep telling me quickly on that. Which is the tax year in which the chargeability under the head capital gains will be attracted? The chargeability under the head capital gains will be attracted. Which tax year? Chargeability. In which tax year the chargeability will be attracted? Conversion of capital asset into a stock in trade. So this is a transfer. Yes, this is a transfer. So does the chargeability gets attracted in the year of transfer, which is the year of conversion? Does the chargeability, is it attracted in the year of transfer, which is the year of conversion? Answer is no. The chargeability is postponed. Indeed, the chargeability is postponed, and the tax year in which the chargeability is attracted is the year in which the stock in trade is sold. We have seen that. And in that particular tax year, when the stock in trade is sold, we have got two chargeability which gets attracted. We have got, students, what? two chargeability students which is attracted. One is under the head capital gains, another is under the head PGBP. And we have taken the example, students. I've given you the examples also in the last lecture. That is point number one. Point number two, students, in this particular context, point number two, students. Compulsory acquisition by law. Even that is also a case of a transfer. Yes, that is also a case of a transfer. But is that also the case of chargeability? Does the chargeability gets attracted? Students, does the chargeability gets attracted in the year of compulsory acquisition? And the answer is no. Indeed. Perfect. The chargeability is attracted in this case, Lakshmi. Radha, Kanaya. Perfect. The chargeability is not attracted in the year of compulsory acquisition. It is attracted in the year in which the first installment, students, it is attracted in the tax year in which the first installment, students, is received. It is attracted in which tax year? The tax year in which the first installment of that compensation amount is received. And be careful, students, that is a year in which you are supposed to do the entire computation of capital gains. That is a tax year in which tax year? The year in which you receive the first installment amount. That is a year in which you will have to do the entire computation of capital gains. This is something which I have already explained to you, students, in the last particular lecture. I hope that all of you are clear with this one and through that example. Okay. The third one, students, one more particular part which was being there, if you can recall that, students. One more particular part, students, that was being there. Yes, Radha. What if the first installment is very minimal? Lakshmi is asking, sir, in that situation, then what will happen? Like, for example, the total compensation amount was, say, 200. Total compensation was, say, 200. Okay. But unfortunately, he got the first installment compensation of 20, only 10%. So question is it something that will be unjust? Yes, it is unjust. That way, in terms of that, it will be a big burden on the SSC. And the answer is yes. It will be a burden on SSC, Lakshmi. We just can't help it. The law does not provide any such of relaxation that the first computation will be only when more than 50% of the overall compensation has been received. जी संकेत अभी नहीं रिवीजन ले रहा हूँ उसके बाद प्रेजेंटेशन I'll also share this one, students. Today's अभी तो मैं रिवाइज कर रहा हूँ संकेत जी लास्ट क्लास का ही जो है ना रिवाइज कर रहे हैं उसके बाद वैसे चलो दिखाई देता हूँ So students, here so the law does not say, students, the law does not say that the first compensation amount or the first installment amount should be 50%, 60%. Only then the chargeability will be attracted in that first year, first installment. In that first installment year. The law does not say so. And that is unfortunate, students. The law does not say so. So if supposingly, Lakshmi, the first installment is a very lower amount, like in my example, only 10% was received. Are you supposed to do the computation of the entire capital gains by taking the full compensation amount, even though I received only 10% in this tax year? Am I supposed to take the full compensation amount and do the entire capital gains computation? Answer is yes. Answer is yes. And that is how the things are to be considered. But practically, students, practically, if you see, this doesn't have, the government is also aware that they will have a taxation burden that they need to cater. And because they are aware that the SSC will have a taxation burden to cater, the first installment is on a reasonable side. If they do a split in terms of the number of installment, then they will do the split. The grievance, students, I'm telling you, the real grievance of the SSC is not, students, just pay attention to this part. The real grievance of the SSC is not that in the first installment you have given me less in that context. That's not the grievance. The grievance can be, students, the grievance can be that, sir, the compensation amount that I have received, the compensation amount that I have received, that by itself is not adequate. The compensation amount that I have received, that by itself is not adequate. That could be the grievance, students, in this case. And if that is a grievance, so what will happen, students? Do you know? SSC may have received is the compensation, original compensation he may have received, but the SSC has already filed an appeal, and in the appeal he is agitating to get a enhanced compensation amount. To get what? An enhanced compensation amount, students. And say, for example, after 5 years, the court ruled out the judgment in the favor of SSC, and he says that instead of 200, the SSC should receive the compensation of 300. That judgment came, say, in 6th year. So now how much is the enhanced compensation, students? From 200, it now came to 300. That is 100 is the enhanced compensation. Kanaya. Now, did the SSC already computed the capital gains on the original compensation of 200 lakhs, where the full value of consideration was taken as 200? Yes, he already computed the capital gains. The full value of consideration was already taken as 200. What about the cost of acquisition? Cost of acquisition was also fully reduced, and the capital gains was computed. So now when the enhanced compensation, which is now extra 100, that is received, say in 6th year, 7th year, whenever. So whether that will be separately be taxable under the head capital gains in the tax year in which the enhanced compensation amount is received. In the tax year in which the enhanced compensation amount is received, answer is yes. Now that extra 100, Kanaya, Radha, Lakshmi, Muskan, that extra 100 that the SSC has received in that 7th year will be taxed separately in the year. In which year? In the year in which the enhanced compensation amount is received. So say, for example, the court judgment comes in 7th year, and it is a 7th year in which I am receiving the enhanced compensation. So that 100, extra 100 will be taxable separately in 7th year. Now, what about the cost of acquisition, students, for that? What about the cost of acquisition, students, for that? Whether the cost of acquisition, will you get the original cost again? Will you get double deduction? Once when you calculated for capital gains for 200, you already deducted fully the cost of acquisition. So again, whether you will get the deduction of cost of acquisition, and the answer is no. Exactly correct. Yeah. The cost of acquisition, students, it is 0. So whatever is the additional compensation amount, students, whatever is the additional compensation amount, is that fully taxable? Whatever is the additional compensation amount, that by itself will become the capital gains, and the answer is yes. Tell me one thing. Now, should in the 6th year or 7th year, whenever the additional compensation amount is received, you people have said that, sir, it will be taxable in that year. I agree. I agree, students. My question to all of you is, what would be the nature of capital gains? When you will calculate the capital gains, when you receive the enhanced compensation amount, where you've taken the cost of acquisition as 0. So that capital gains that will be calculated, will it be referred as long-term, short-term? That depends on what? That depends on what, students? Tell me. Let me put the question in different way. when I'm calculating my capital gains at the time of the enhanced compensation amount, if my original capital gain is short term, original computation, Kariya, if that is short term, is it possible that the subsequent computation will become long term? Because 7 years, na? I received after 7 years, kind of a thing. So if the original was short term, is it possible that the enhanced compensation at the time when I receive my enhanced compensation amount and I do the computation of capital gains on the enhanced compensation amount, can I say now, because I receive after 7 years, it will become long term? Can I say so? Answer is no, students, never. The character of the asset, Lakshmi, the character of the asset and the character of the gain that you have considered, rather, the character of the asset and the character of the gain that you have considered at the time of the original computation. At the time of the original computation, the same will be the character at the time of the enhanced compensation. The same will be the character at the time of the enhanced compensation computation. So the character will not change. I hope that all of you are clear with this one. Perfect, students. Very good. After this, students, after this, we went to the next particular part. If you can remember that insurance compensation money received, the destruction of the capital asset, and on account of that, the insurance money was received. Then we have seen that the even that insurance money received, even that insurance money received, students, that is chargeable under the head capital gains. Insurance money received, students, that is chargeable under the head capital gains. Even that has been seen by us. Which year it will be chargeable, students, under the head capital gains? In the tax year in which the insurance money is received. In the tax year in which the insurance money is received. Is that clear to all of you, students? Okay, not in the year of destruction. Not in the year of destruction, but in the year in which the insurance money was received. I hope that even that has been considered by you. But only one thing, students, I taught you in the last lecture, which you should not forget. Two things, students, I have told you in the last class. Two things I have told you in the last class, students. And what was that? One, the period of holding, students, as a concept. The period of holding as a concept is used only for the head capital gains. We don't use this period of holding as a concept for any other heads of income. And why is it so? Why period of holding as a concept is used under the head capital gains? Because it is very important to know that the asset, is it long term or short term? Depending upon the nature of the capital asset, that the computation probably might change of the capital gains. Not only the computation, even the corresponding rate of tax changes. That we all are aware. And therefore, the nature of the capital asset, short term or long term, primarily that is important, and for that, period of holding becomes critical. I told you two important things in the last class about the period of holding. Point number one was the period of holding, students, should be as a capital asset. Should be as a capital asset. That is point number one. If you have not have taken a note of it, please do take a note of that also. The period of holding should be that. The period of holding should be that as a cap, or the period of holding should be that as of a capital asset. Should be of a capital asset. The period of holding should be that of a capital asset. The period of holding should be that of a capital asset. Why? Because I told you, in the case of conversion of capital asset into a stock in trade, what happens, friends? In the case of conversion of capital asset into stock in trade, what happens in this case? After the conversion, the asset no longer remains as a capital asset. It becomes a stock in trade. So you may be holding the property. You may be holding the property in this case, but the asset no longer remains as a capital asset. It becomes a stock in trade. And you are holding the property as a stock in trade thereafter. And what I told you just now, students, what I told you just now, the period of holding should be that as of a capital asset. Should be of a capital asset. The period of holding should be of a capital asset. That is what is relevant. And secondly, the period of holding should be up to the date of transfer, not extended to the date of chargeability. What I told you, second point, the period of holding should be up to the date of transfer of capital asset and not to be extended in the year of chargeability. Not to be extended in the year of chargeability. Like compulsory acquisition by law. Compulsory acquisition by law. The asset was transferred. In which year the asset was transferred? In the year in which the compulsory acquisition took place in law. The asset got transferred. Although the chargeability is postponed. The chargeability is postponed in which tax year? In the year in which I received my first installment. But the asset was already transferred. I no longer hold the asset at all. So will you count the period of holding up to the tax year? Up to the tax year when the chargeability was attracted? No. The chargeability may be postponed, but the period of holding has to be computed only up to the date of transfer. Is that point clear to all of the students? Everyone. In this case. Fine, Radha, Lakshmi, Kanaya. So students, what do you do? The capital gains module is also up. The capital gains module is also up now in our Board of Studies website. This many concepts which I have taught you up till now, you may refer the section from there also. These many sections, students, you may refer it from so from these many sections, you may just refer it from there also. Because these are the base level, but what is important was the notes which I gave you in the last lecture, the written notes. That becomes a very critical, this thing. And why it was such a critical particular observation, students? The criticalness, students, as you can see in the last class, was because of the fact that this is here, students. So the students, the criticalness, as you can see, was there because of this entire conceptual part that we discussed. The conceptual part that we discussed. Now, students, all the further discussion, students, every session we will have a theme-based approach. Like I told you, capital gain, students, you have to learn in the context of some themes. Entire CG, students, you can learn it from as a theme. Like, primarily, the business restructuring, taxation of real estates, taxation of shares and securities, So if you make a categorization, students, the way students remember, like the way we did for employee, we have created an entire list at one particular place, and that gave us a very focused particular analysis. This is for the employee. You revise, you re-revise, probably in that particular manner. Do you all agree? That is exactly how, students, we have developed even for this. So students, even for this one, students, for the ensuring that the small place does not get diluted at different scenario, I have combined everything at one place only. Students, in the last lecture, I told you, all of you, to read section 70. Because today's session would be mainly on section 70 of your Income Tax Act 2025. Section 70 of the Income Tax Act 2025. Now, students, what is this section 70? Students, section 70 says that certain transfers will not be considered as a taxable transfer. Certain transfer will not be considered as a taxable transfer in that context. Okay. So now then they give you the list. There are lists that goes in that section. And that list is from 70 subsection 1 clause A onwards it goes. A to, I am not aware of the last serial number, but it is. In the Bear Act you can see. 70 clause, subsection 1 clause A, clause B, C, D, and these are these are all independent different situations. These are all independent different situations, students. From A, B, C, D, E, F, G, H, so on and so forth. Okay. So one point, students, which I will just want all of you to take a note of this act. Students, last lecture we did section 67. Last lecture we did section 67. Now 67 was the general charging section. All that list that I given, 67.1, 67.2, all those sections that I have given it to you. So they were all covered in the general chargeability. Couple of them are still pending, but they are for real estate, and that therefore they are pending. One is for partnership firm, that is pending primarily. So that I'm going to take you across separately. Okay, real estate and partnership firm. But 67 per se is like a general charge. Then there is section 68 and 69 that we will do today. That is buyback of shares. I told you in the last lecture also. Heavy amendment, Finance Act 2026. This we are going to do it today. And also liquidation of company. And these chargeability on the gain arising on the buyback and the gain arising on the liquidation of company, the chargeability of those gains are covered in section 68 and 69. And after that, we have got section 70. And what is section 70? Probably section 70 is transaction which is not considered as a taxable transfer. Now, can you students always remember now? Don't remember the subsection, at least now it is not required, but 67, 68, 69, and then 70. So 67 is a kind of a list of all the chargeability that may I say and put it like a general charge. 60 and 69 are specific charge which is in respect of buyback and other one. One is the liquidation and another one is a buyback. And then 70 is the transactions which are not going to be considered as a taxable transfer. And they have listed from 70 subsection 1, then clause A, clause B, clause C, so on and so forth. Many of the categories they have developed. One of the categories students that they have developed, may I put it to all of you, is clause C and clause D. But before I do, we will touch clause C and clause D, which is this one. Just see the opening words. Be careful, students. 70 subsection 1 opens with the word, the provision of section 67 shall not apply to the transfer. Which transfer? The transfer which are mentioned from the transfer students which are mentioned mentioned from which section to which section? From transfer which are mentioned from clause number A, B, C, D. I think to M. I'm not aware, students. We will just have a look. I don't know which is the last particular category. We will see that particular thing as and when we come. Okay. Now my question to all of you students is my question to all of you, therefore, it is, what about section 6, the transfer under section 68 and 69? Will they be eligible for any exemption? Students, pay attention. Huh? Will they be eligible for any exemption in respect of the transactions which are covered in section 70? Answer is no. 70 talks about granting the exemption only in respect of the chargeability which is attracted under section 70. Sorry, under section 67. Students, can you just take a note of it? Please, all of you. Just take a note of it. Give the heading, section 70. Transactions not regarded as a taxable transfer. Transaction which is not regarded as a taxable transfer. Students, in that you write. In that front you write. Section 70. Provides the exemption from the charge of capital gains. The exemption from the charge of the capital gains. Full stop. So just let me take the Braille Act so that I will be in a position to give you the specific clause number where it ends. Just a second. Section 70, subsection 1. Provides exemption on transfer in respect of the transactions covered in section 71A to section 71 to section 71 ZL, all smaller, ZL. Full stop. Right further. However, now this is important, brother. However, the said exemption applies. The said exemption applies only in respect of the chargeability which is covered in section 67. In section 67, full stop. Underline the word section 67. Next line. Therefore, the chargeability covered in section 68. Please write in the bracket liquidation of company, comma, liquidation of company, bracket complete. Section 69. In the bracket, write students, buyback will not be eligible for the exemption under section 70. The exemption under section 70. Full stop. Is that point clear to all of you students? That much opening remark is fine. Before we start off with these transactions which are there in section 70, the transactions which are not considered as a transfer and accordingly not chargeable. This particular part is very important. The exemption therefore is in respect of the chargeability which are covered under section 67. Those chargeability which is for buyback and for liquidation. Liquidation is 67, 68 and buyback is 69. So chargeability for liquidation and chargeability for the gain on buyback, that will not be eligible for the exemption under section 70. This is how students they will test you in your CFL examinations also. You need to be ready for that. And based on that, students, now I have selected students those cases like business restructuring students. I have selected students now the cases of business restructuring. The theme is our business restructuring. Let's have a look to business restructuring students. What do we get? One student, the case is 71C and 71D. 71C and 71D. Now, what does it say, students? I don't know whether you people have done this in Inter-CA or not. Earlier, it was section 47 in the old act. Now, in the new act, it is section 70. So students, if you may be aware of this particular point, if you are, are you aware of it, students? This one, students, just have a look. So say for example, this is a holding company. Okay, and it is having its 100% subsidiary company. 100% subsidiary company or wholly owned subsidiary. WOS, wholly owned subsidiary. Now, this holding company, students, is having a factory building. So, factory building was being transferred to its subsidiary. Which subsidiary? Not normal subsidiary. It is WS subsidiary. What is WS? Wholly owned subsidiary. So, the holding company, students, has transferred the asset, a capital asset, to the 100% subsidiary, or any asset like shares, land, building, any asset has been transferred to the wholly owned subsidiary. And second situation is a vice versa situation. What is vice versa situation? Where a subsidiary company has transferred any capital asset to its 100% holding company. Okay. Now here, what they say is that this transfer, students, they say that it is the fact that it is 100% holding, 100% subsidiary, to whom or from whom the transfer is taking place. Therefore, don't you think that it is like just the same thing in the family? The asset is still in the family without any outside interest in that asset. Without any outside interest in that asset. So the fact that there is no outside interest that has yet materialized in that particular asset, we say what? That such transfer is not a taxable transfer. Why? Because the asset continues to be in the same family itself without any outside interest in that particular asset which has been transferred. Because the transfer is to a wholly owned subsidiary or from a wholly owned subsidiary to its holding company. It remains in the family without any interest on that asset which is transferred of an outsider. Outside interest is not there. So they have said that it is not a taxable transfer. They have got only one important condition over here, friends. At the time of transfer, there is one important condition. At the time of transfer, there is only one important condition. I'm repeating this part because this condition is at the time of transfer. And the condition is that the transferee company, who's the transferee company? The receiving company. The transferee company should be an Indian company. Should be an Indian company, students. This condition, students, you will appreciate maybe when you do the international taxation at that particular point of time, you will appreciate why this condition has been used. Right now, it might become a bit premature. Obviously, the curiosity will be there, but we'll hold on to this temptation. Might be when we do NR taxation, because just to give you a brief, if it is, so they have said that they have said that the transaction will not be considered a taxable transfer if the capital asset is transferred to a wholly owned subsidiary or from a wholly owned subsidiary to its holding company. The only condition is the transferee or the receiving company should be an Indian company. Why this condition is important? Because when the Indian company will be transferring the asset subsequently, at that point of time, the government will be in a position to charge this particular Indian company within this Income Tax Act 2025. The fact that this Indian company happens to be a resident. So the government will be in a position to charge this Indian company whenever the subsequent transfer will take place from this Indian company. That is the underlying logic. Why they are trying to put this condition that the receiving company should be an Indian company. Because whenever the Indian company will be transferring the asset subsequently, the Indian company being a resident, their world income will be taxable in that way. Isn't it? So whenever subsequently when the Indian company will try to transfer this asset outside, they will be in a position to tax it. This is the underlying logic behind why the transferee condition is always that the transferee company should be an Indian company. Transferee means receiving company, students. Transferee means the receiving company should be an Indian company, students, and that exactly is the point. So I hope that all of you are clear with this one. Okay, so this is the thing which has been there. Now, apart from that, there are some additional condition that needs to be satisfied, students, in this context. And what are the additional conditions, students? Let's have a look. Please have a look, students, over here. In this case, can you just say 1.3? 1.3? Students, have a look to 1.3. Exemption is withdrawn if before the expiry of 8 years, either A or B must have happened. Before the expiry of 8 years, either A or B, one of the two, if it is happening, then whatever students, the exemption is withdrawn. Do you know the consequence of withdrawn? What does it mean? Withdrawn would mean that whatever is the capital gains that got exempted originally because you enjoyed the exemption of 17, that will be deemed to be the capital gains of which year? Of the year of default or in the year in which the original transfer has taken place. Which year it will be considered as deemed income? The year when the default has been committed or the year in which the original capital gains which was exempt, that original capital gains was computed. Students, it is the original capital gains which was computed but exempt because of section 70. That's the reason why, students, did you notice this one? The exemption is withdrawn. That is the word that they are using. Which word? Exemption is withdrawn. They never use this word, students. And you will not find any particular, you will not find such languages for defaults written in the taxation laws. Whenever what we have seen is that whenever there is a default, they say that it is considered as an income in the year of default. Whenever you do the default, that is the year of income. But this is a very unique case where they say that the exemption that you enjoyed originally will be withdrawn. That much of the language itself is sufficient to tell you that if you commit the default, which default? We will see that default, A or B, we will see that default. Then in the year in which the original computation that has been done, for which you claimed an exemption, because the exemption you claim because of the original transaction which was covered in section 70, that year this deemed capital gains will emerge. So say for example, in year number 1, the holding company has transferred the factory building to its wholly owned subsidiary, which is an Indian company. So in year number 1, the holding company enjoyed the capital gain exemption of section 70. Now in year number 4 or say in year number 5, the subsidiary company or the holding company, whatever it be, they have committed a default. Which default? The default yet we are supposed to see either point number A or point number B. Say in year 4 and 5. Then what happens? Then in that case, what they say, the exemption that you enjoyed in year number 1 is withdrawn. Withdrawn means what? Although the default has happened, say in year number 5, primarily, but the capital gain exemption that you enjoyed in year number 1 stands withdrawn, and hence it will be deemed as the capital gain of year number 1 itself. So do you know what will happen? In year number 5, the reopening will take place. Your case will be reopened and it will be added to the income of year number 1. Capital gains of year number 1, tax liability of year number 1. Do you know the consequence? What is going to happen? There will be a huge amount of interest I'm not even leave aside the penalty for a time being. Just imagine the interest, because you are computing in year number 5 when the default has happened, and this computation is of which year? Year number 1. This computation is of which year? Year number 1. And that exactly is the point, students. Just imagine this kind of a scenario. The interest that will accrue over a period of time, because you are doing the computation in year 5 in respect of the income of year 4 now, because the exemption stands withdrawn. Now the question is that, sir, what is the default? The default is either A, the transferee company converts the capital asset into as a stock in trade. The capital asset which got converted is now treated as a stock in trade, students. That is the first default. And the second default is, one of the two defaults is sufficient. Second default is the parent company or its nominee, the holding company, you can say. The holding company should cease to be holding 100%, or may I say simple words, the holding company cease to remain a 100% holding company. As simple as that. So it has become, say, 90% holding company that way. So therefore, if one of the two default has emerged, primarily one of the two default has emerged, it will be, students, what will happen? The exemption that was being claimed earlier, the exemption that you have claimed earlier, students, that exemption will be withdrawn. I'll just give one small example so that you people can imagine the implication why they have done this. Because what happens is that students generally don't understand the logic behind this, and therefore they fail to appreciate why they have created such kind of a condition. Let me in fact give you a bit of this thing. Supposing, students, this is A Limited, a holding company, and it transfers a capital asset to B Limited, which is 100% subsidiary. 100% subsidiary or wholly owned subsidiary. Now this capital asset, whatever it be, say its value, students, is say 250 crore. Now what happens, students, in this context? Now this transfer is an Indian company, ICAI. This transfer is an Indian company, ICAI. So what happens now? So if you see the transferor, students, the transferor who is there, that is an Indian company. This transfer, students, what happens? In the hands of this, the capital gains. Section 70 comes into picture. So therefore, nothing is taxable. Now just imagine the students. Do you know what has happened in B Limited after this transaction, students? Just imagine B Limited balance sheet. B Limited balance sheet, students, suddenly has got a 250 crore worth of an asset in its balance sheet. B Limited balance sheet, just imagine, students, the B Limited balance sheet, a 250 crores worth of an asset is shown in this balance sheet. What happens? Suddenly the share price, the shares of B Limited, don't you think that the shares of B Limited, because the asset value has increased, the share price will also increase? The share price will also increase. And then what happens, students? Now, in this case, A Limited, now knowing that the share price has increased, what the A Limited is doing? A Limited is selling. Selling what? Selling the shares of B Limited. And now it is ready to pay capital gains tax on the share transfer. But then please understand, this was majorly was because of what? The share price increase was majorly because of what? It was majorly because of this particular 250 crore transaction of the asset which shifted from the balance sheet of A Limited to B Limited. This shifted from the balance sheet of A Limited to B Limited. So therefore the price of that B Limited particular share price has gone up because the asset portfolio has gone up. So the share price also will go up. And now A Limited, now he is selling the shares. He says that I'm not selling the asset, I'm selling the shares. Shares is what I've sold. I'm ready to pay capital gains tax on the shares which I have sold. That is it. So the law says that, wait a minute. The fact that within 8 years you have sold it, your intention was to encash this property transaction through what? Through the share price increase of your wholly owned subsidiary. That property transaction which got shifted from your balance sheet to the subsidiary company's balance sheet, in which the subsidiary company balance sheet, after the asset transferred, it went up, the asset portfolio went up, so was the share price. Accordingly, this particular context, A Limited is selling the shares, and now what it has avoided, students, this is known as tax avoidance. What he has avoided in this particular entire arrangement, he has avoided, students, the in this entire arrangement, students, what it has avoided, the capital gains tax on the transfer of what, students, the capital gains tax on the transfer of, indeed students, the capital gains tax on the transfer of the land of 250 crores worth. And therefore, what the law says? Law says that no. What we will do, we will make you pay for this. The capital gains which was exempt here, now this will be withdrawn. And according the 250 crores worth of capital gains competition will be undertaken, and it will be considered as the income of which year? Income of which year? The year in which the capital asset was transferred. That is how it would be. And the shares that you have transferred separately, that is a separate capital asset transfer. So there are two capital gains that will be calculated. Capital gains number one would be in respect of the asset which was transferred. Now we are taxing it because it's the default that you have undertaken. So now we are taxing it by withdrawing the exemption. So now we are taxing it, and the capital gains number two will be the shares that you transferred separately. For that also we will tax you. This is what, students, this particular point is all about. I hope that you can appreciate why they have done this thing, 8 years condition, and what should not be done in that 8 years. Because if you do this thing in 8 years, then in that situation, your exemption will be withdrawn, students. Your exemption will be withdrawn. I hope that all of you are clear with this one now. Every one of you. On this particular part, students, any doubt that you have to ask, please ask me before we proceed further quickly.
Sir, so any effect which is taking place on the capital asset transfer, giving rise to the net worth of the company, that would be said as taxable from the year in which that exemption was given.
Yeah,
Is
yeah,
it that?
yeah.
So it is not like, okay, asset was there and then shares price increase. It can be any other transaction also, right?
Yes, any transaction. But transaction has to be between any transaction.
But why would the assessee would be doing that kind of things? That was I was pondering upon. Like if shares in the securities, you need to pay tax at the concessional rate. That is the reason.
Yes, exactly.
Okay, sir, got it.
I hope that all of you are clear with this one now, students. Any doubt? Shall we proceed further? So now, students, in this particular context, this is how it has to be considered. Now, this is about the holding and subsidiary company. Generally, they will ask you in the examination, this default part, they don't target it. What they target generally is the normal transaction, where you will find in the examination question, but you should know that if there's a default, then what exactly is the implication? Because the implication is very severe. Up till now, we have seen that whenever there is a default, the income is considered of the year of default. But this is a unique provision where the income is considered not of the year of default, but the income is considered of the year in which the exemption was being granted earlier. That is the danger of what shown this particular provision. And this is exactly the point. That is the danger of this particular provision, students, and that exactly is the point. Now, therefore, students, in this regard, let's have a look to the other particular part in this context. So over here, the second particular part, now let's come to the second one. This is an important one, students, and this, please be careful. The buyback of the shares, students, be careful. the buyback of the shares. So students, over here, this is an amendment that has taken place. The buyback of the shares or other specified security, section 69. Very important amendment, students, and very important section. Now, students, you may be, I'm not going to the Companies Act level of provision, which you all are aware of it. So, whenever there is a buyback that take place, generally, students, see, buyback, you all are aware, it is of the listed securities. Generally, it is the case, but yeah, we have seen that even the unlisted securities, the company whose shares are not listed, that even that company also does the buyback. So there is no hard and fast rule, primarily in the practical case, but generally we have seen that the buyback is done by Reliance or the buyback is done by some Philips, so on and so. There were very popular buyback transaction that was held in past. Kirloskar have also done the buyback earlier. Cipla. So these were the companies which were involved in a very big buyback schemes. But as I was telling to all of you students, when you talk about the buyback of the shares in this context, obviously, who is the one who receives the gain in this context? Who is the one, students, who receives the gain? The gain is received by the equity shareholder. By the way, there are 2 or 3 things, students, be careful before we proceed further. And I tell you, students, there is a buyback of equity shares. For this only we are reading the special provision. Friends, for this only we are reading the special provision, and this special provision is under section 69, buyback of equity shares. And students, you may be aware there is another particular case, redemption of preference shares. Redemption of preference shares. Redemption of preference shares, for that there is no specific provision. And if redemption for preference shares, if there is no specific provision, students, it will go under which section? It will go under section 67(1), the general charging section. Do you all agree? For buyback of equity shares, we have got a specific chargeability under section 69. For redemption of preference shares, you are so there are 2 particular class of the shareholders. One is the equity shareholders. For equity shareholders, we don't say redemption of equity shares. There is a buyback of equity shares. For preference shares, there is a redemption of preference shares. So we have a specific provision for the equity shares. We don't have a specific provision for preference shares. Now, why I'm emphasizing this much, students, to all of you? Because I'm trying to tell you which sections governs what. For the buyback of equity shares, the charge is under 69. For the redemption of preference shares, the charge is under 67. And what is the importance of this charge? I just now have told you under section 70, if at all there is an exemption in respect of the transaction, if at all there is an exemption in respect of the transaction which is covered from from clause number A to clause that ZL, if I'm not wrong, then that exemption is in respect of, that exemption, students, is in respect of, indeed, very good, the chargeability which is covered under section 67 and not the chargeability which is covered under section 69. Is that point clear to all of you? All of you are clear with this one, students? In this context? Okay. After this, students, just think of the shareholders only. What is happening, students? The shareholders' right is getting affected. Didn't I told you the legal, this is a capital asset. The right is getting affected by buyback of equity shares, by redemption of preference shares. The shareholders' rights are getting affected. And in our last lecture, I told you what? The capital asset means a legal exclusive right. So these are the sophisticated example of the capital asset whose right getting affected results into a transfer, and accordingly the charge. These capital assets whose rights are getting affected, because of which, on account of transfer, and hence there is a charge. Now we have to identify what, under which section the charge is attracted. Do we have a specific provision which is 68 and 69? 68 is for liquidation, 69 is for buyback. If the answer is no, then the charge is going under which section? 67(1), the general charge. I give you one more example, students, where the shareholders' rights are getting affected. Their shareholder rights are getting affected, students. And the third one, students, I must tell to all of you, the third particular example where the shareholders' rights are getting affected, students, and what exactly it is. The third one, students, reduction of share capital. This is redemption, by the way. Third one is, students, reduction of share capital. I think you all are aware, the share capital being reduced from rupees 10 per share to rupees 5 per share. What happens now? Tell me what happens now. Is this a capital asset? Yes. Is there any alteration of the right? What is the capital asset? The right. Now, are you altering the right of the shareholder by reducing the share capital? Again, the answer is yes. So that is resulting into what? Extinguishment of their right. Is it a transfer? Yes, it is a transfer. Is a reduction of share capital equal to a buyback? No, it is not equal to buyback. So therefore, the chargeability on reduction of share capital, that chargeability will not be attracted under section 69. Where it will go? It will go under section 67(1). So reduction of share capital, where is the charge? 67(1). So the general charge in the case of shareholders' right getting affected on account of extinguishment in the nature of buyback, extinguishment in the nature of redemption of preference shares, extinguishment in the nature of reduction of share capital. All the three are the cases of that. So where is a specific charge? 69, which is for buyback, for redemption of preference shares, for reduction of share capital, there is no specific charge. Therefore, it is covered under the general charge of 67(1). So therefore, whether these general charge covered under section 67, will they be eligible for exemption under section 70? If at all that is applicable, answer is yes. What about for buyback? Buyback, the gain arising from the buyback, which is chargeable under section 69, will that be eligible for exemption under section 70? Answer is no. Is that point clear to all of you or not, students? Please tell me. It's not only what 70 students. See how the first class I told you, the right is the capital asset. These are the rights which are getting extinguished. And therefore, the capital asset is getting transferred. You have to identify under which section the charge is attracted. I hope that all of you are 100% clear with this one, students. Now, students, one very important amendment I will tell you what has happened in the Finance Act 2026. Earlier, students, there was a case of that whenever the buyback will happen, whenever there is a buyback of equity shares, the position of chargeability on the income, arising on account of buyback, that chargeability, students, was pushed in the head IFOS as deemed dividend. It was referred as what? As a deemed dividend, and accordingly it was charged under the head IFOS. Specific chargeability. See, if the law gives a specific chargeability, you just can't help it. If it is specifically charged in a particular head, that is the head where the chargeability will be attracted. It's a specific charge. Now, what is the amendment that has happened, students, in Finance Act 2026? The amendment that happened was, this is the amendment, students. Buyback and deemed dividend post this thing. That deemed dividend definition, students, which was there, that deemed dividend definition, section 2 clause, this one, 2 clause 40 in the bracket F. This particular clause, students, in this case, Earlier, this was considered as a dividend. This is the definition of deemed dividend. You'll say, sir, what is this 2 clause 40 subclause F? This is the definition of students deemed dividend. Deemed dividend definition students. Deemed dividend students. Now, this particular deemed dividend definition students in this context. So buyback, what they used to say? Purchase of own shares. Before this amendment, purchase of own shares means buyback. So whatever is a income payment by the company towards the purchase of its own share, that payment by the company towards the purchase of the own share was considered as students as a dividend. Can you see that? Was considered as a dividend. So that shareholder, whatever money that they used to receive, they should charge it under which head? IFOS. Now this entry has been omitted with effect from 1st April 2026. And what they did, students, in this context, they have omitted this. Not only that, they have omitted this. So by omitting this, students, it is no longer treated as dividend. All of you agree? No longer treated as dividend because this 240F is no longer applicable with effect from 1st April 2026. So therefore, it is not treated as dividend, and therefore the shareholder who receives the amount, for them there is a charging mechanism separately made under section 69. There is a separate charging section, students, which is created under section 69 and they had capital gains. Earlier in the old law, it was also there in the form of section 46A. The problem was that, this is the problem. Earlier, buyback, they have said that capital gains. Then for some years, they said that no capital gains, it should be a IFOS income. Now again, the new amendment. They said that no, it should be a capital gains income. So therefore, what they did, they deleted that entry of deemed dividend of section 240F. That entry has been deleted. Now they have charging that particular buyback payment under the head capital gains. But there is a important particular point that you should know, students. This chargeability is a bit different. Now, students, what they are doing, if you see this particular table, just have a look, students, what they are done. Before that, I need to make you comfortable with the 3 particular section where there is a special rate of tax. Are you aware of that? 3 sections where there are special rate of tax. Section 196, 198 in this context. This is short-term capital gains and this is long-term capital gains. Are you aware of this thing? Short-term capital gains and long-term capital gains. What it is? 196 and 198, students. 196 is short-term, 198. This is a special rate of tax. Earlier, you remember, earlier you had 111A and 112A. These 3 sections. So what is that? 111A, if you can recall, the gain arising from the transfer of short-term capital asset being equity shares or equity-oriented mutual fund on a recognized stock exchange on which STT has been paid. That short-term capital gain, students, was taxed at the special rate of 20%. Now the same short-term capital gains, which was earlier in 111A, now that is in section 196. What is 196? Gain arising from the transfer of capital asset being equity shares or equity-oriented mutual funds in a recognized stock exchange on which STT has been paid. This particular short-term capital gains is taxed at a special rate of 20%. Okay. And then what is this 198? Same particular asset transfer, same asset transfer, but in the nature of long-term capital gains. In the nature of long-term capital gains. Now for that, students, the rate is 12.5% in X, and that 12.5% is to be applied in excess of the long-term capital gains over and above 1.25 lakhs. Over and above 1.25 lakhs. I think all of you are aware of that proposition, isn't it? So that is what this 198 is. Apart from that, the general long-term capital gains, students, is under 197. There is one more long-term capital gains, which earlier it was, students, 12%. So other long-term capital gains, students, it is under 197. Okay. Like for example, students, land, building, jewelry, that will go under 197. Even shares and securities, students, can go under 197. Like unlisted shares. Because 196 short-term capital gains or 198 long-term capital gains, they are talking about the security, equity shares or equity-oriented mutual funds, which is transferred in a recognized stock exchange on which STT is paid. So the fact that you're talking about the recognized stock exchange, you're talking about listing. These are all listed securities. Otherwise, the transfer precisely is not possible. Isn't it? Logical. So therefore, if it is an unlisted particular security which has been transferred, now you tell me, unlisted security getting transferred, whether 196 or 198, will that be applicable? No. So if the unlisted security, if that is transferred and that is in the nature of a long-term capital gains, that is in the nature of a long-term capital gain, students, then its chargeability will be attracted under which section? Indeed, students, its chargeability, students, will be attracted under section 197. And what is the rate of 197, students? What is the rate of 197? Same 12.5%. No difference. Perfect. Same 12.5%, students. No difference. Same 12.5%, students. No difference. That exactly is the point, students. But okay, 198 long-term capital gain, students, it is also 12.5%, but that 12.5% is in excess of 1.25 lakhs. That is 198. Whereas as far as 197 is concerned, it is 12.5% flat. 12.5% flat, students. By the way, students, long-term and short-term in the last class I already told you. Long-term and short-term, students, in the last lecture already we have discussed. And what is that? 12 months long-term capital asset. There is a 2 period of holding. Long-term and short-term capital asset decided is 2 period of holding, 12 months and 24 months. That 12 months and 24 months. So remember 12 months. 12 months is for listed equity shares or listed securities or zero coupon bond, unit of UTI. So listed shares, securities, UTI, zero coupon bond, these are listed. That is 12 months to decide whether long-term, short-term, and all the other 24 months. So if it is unlisted, students, unlisted, then or land or building or jewelry, to decide whether it is long-term or short-term, to decide whether it is long-term or short-term, 24 months. To decide whether it is long-term or short-term, students, 24 months. I hope that every one of you are clear with this one. Now, on that backdrop, students, with this knowledge, just come back now to this. See over here, students, what they have done. I'll tell you what these people have done. Now, in this, students, you will find suddenly a spike. They said that, see, boss, what they are saying, I'm telling you, students, the crux of it. Huh? First, just all of you just pick up the crux of it. What they are essentially trying to say, that buyback, when the company does, it does in a good premium. Generally, see, when the company is doing a buyback, it means it has got a huge reserves. Only then they are doing a buyback. And the buyback ratios are very huge. Otherwise, the shareholders will have to agree in the AGM to agree for the buyback. And they will agree only when the rate is good. And definitely that is a very premium as compared to what is generally offered in the market. They will not offer the market rate. They will top it up. They will top it up, students. The buyback, at least of the good listed companies, they will top it up. Government knows that. It's just like a lottery that happens. So the government, what they have done, the thought process of this amendment is that the promoters level, they are the one who are holding the maximum particular chunk. And these people will earn the thing as compared to other than promoter. Like for example, in Reliance Industry, there are set of promoters. We all know who they are. They will hold the biggest chunk. And then there are retail investors like VS. So they say that these promoters are going to earn fortune when the buyback will take place. So what we'll do is that apart from the normal tax that will happen, we will also impose on them some additional tax as well. Additional tax as well, students. So the normal part, whatever is the normal charge of tax, that will happen under these sections that I discussed. But apart from that, they will have to share a burden of additional tax. To whom I'm talking about? Promoters. And students, apart from that, what about the surcharge? Even surcharge students, they will have to bear a flat rate. Who? I'm talking about the promoter students. Those promoters who are going to earn bounty or fortune at the time of buyback. For them, the government have said that you will have to pay normal tax plus additional tax plus a flat surcharge. Under what cases this will be? Let's have a look. Just imagine they are going to earn fortune, students, in this context. That is a philosophy which went in designing the entire taxation scheme. See here, short-term capital gain, students, of 196. Let's take one by one. Short-term capital gains of section 196 over here. What is the rate? Non-promoters ordinary tax. So this becomes what? 20% under section 196. You are a non-promoter, students. So what is the normal rate? 196, 20%. Just if you finish all the non-promoter, like for VS, people like us who are non-promoters of the companies. So for us, always students, it is what? Normal rates only. Whether it is 196 or 197 or 198, whatever it be, doesn't matter. Obviously, I told you the difference. 197, 198 difference, I have already told you. 198 was that equity shares long term in a recognized stock exchange. STT paid 12.5% is the rate, but in excess of 1.25 lakhs. Whereas other long term capital gains, it is 12.5% flat. Short term capital gains, only one special rate, 20%, that is to equity shares transferred in the recognized stock exchange on which STT is paid. 20%. Now just have a look, students, the promoter game. Promoters. Who are the promoters? Just have a look. Now they have said that promoters either can be a domestic company or the promoters can be other than a domestic company. Like we know, many of the big companies, the families are the one who are the promoters. So they are not a company. And in certain cases of a company, the promoters are also another company, another domestic company. The promoters are a domestic company. Hence, A Limited, the promoter of A Limited is B Limited, domestic company. So if it is the case, and then there is a short-term capital gains of that 196, then students, what is the rate? 20% is the rate in this context. 20% students. That is the normal thing. Plus the additional tax. Students, what is the additional tax? 2% is the additional tax. 2% is the additional tax, students. And that exactly is the game, students, in this context. For the promoters, so 20%, 196 is a base rate to everyone, plus 2% additional tax if it is a promoter being a shareholder, and it is receiving the payment on account of buyback of its share. So the promoter is a domestic company which is a shareholder, in another company, and that another company is doing the buyback. So therefore, this promoter domestic company is receiving the money on buyback. So it will have to pay the capital gains at the rate of 20%. The tax would be at the rate of 20%, which is the normal rate of tax, plus the additional tax would be at the rate of 2%. Then if it is other than a domestic company, then like an individual in Reliance, he's a promoter. And then what happens? And the gain is the short-term capital gains. Understand, these are listed securities in a recognized stock exchange. Okay, then in that case, 20% is the normal rate. Plus for the individual students, can you see 10% is the additional tax that they will have to suffer. 10% students is the additional tax that they will have to suffer, and that exactly is a game. Now, what if if it is a short-term capital gains of an unlisted shares students? Then what happens? Students, tell me and think logically. You will earn fortune, students. You will earn fortune from a listed company's buyback or unlisted company's buyback. Listed companies buyback. Think logically, and the way the government have drafted what they have their things in mind, and they've seen recently the kind of buyback that has happened. The government have all the data. The ratio at which the market price is 100, you are doing buyback at 220. Just imagine this kind of buyback at 220. So therefore, in that situation, the government knows this particular factor, that this is a fortune people are earning, and that is a buyback of a listed share. Unlisted share buyback. Unlisted share period of holding is 24 months. Supposingly, I am holding an unlisted shares. My period of holding is say 18 months. It is a short term, and there is a buyback that has happened. If the buyback has happened, then they say that we don't want to put any special provision. No special provision. Check out, do we have any special rate for that? No, there is no special rate also. Under the normal provision also, there is no special rate. And what is the rate applicable for a short-term capital gains other than 196? Other than 196, what is the short-term capital gains? The normal rate. If you are the individual, it is a slab rate. If you're a company, there is a flat rate applicable to the company. Whether you're a domestic company, then 30, there is different rate. If you're a foreign company, it is 35%. That is how it happens. So therefore, and there is only normal taxation if you are under this category. That is it. Because understand, their intention is to charge the fortune. Who is earning the fortune at this stage? That is where they want to charge. That is exactly what their intentions are. Fortune is not earned when the buyback is happening of the unlisted. So therefore, you will find unlisted buyback, whether you are a promoter, or not. So just have a look. Do we have any additional tax here? No. Whether you are a promoter company or you are an individual promoter, we don't care. No special provision for unlisted item. Okay. Let's come to the long-term capital gains. Again, long-term capital gains, their target is only listed companies. And therefore, the target is 198. In 198, you pay the base rate of 12.5% over and above the long-term capital gain of 1.25 lakhs. So this everyone pays. I, as a non-promoter, will pay. The main person who is a promoter, he will also pay at the rate of 12.5% over and above 1.25 lakhs. Everyone pays. But he being a promoter and he is earning a fortune, therefore he will have to pay the additional tax also. And how much is the additional tax? For long-term capital gains, can you see this? Additional would be 9.5%. Over and above at 12.5% that you're paying. Additional is 9.5%. For a promoter which is a domestic company. And if you are not a domestic company, you are a normal individual, then your rate, students, is how much? Then your rate is 17.5%. 17.5%. 17.5%. And that exactly is the point, students. 17.5%. Fine, students. Other
Sir,
than
even
that,
in the unlisted also, they are charging the same amount, na, sir?
yeah, that I'm coming. That I'm coming to 197. That I'm coming to 197. So 198, all of you are clear with this one for listed part? Now, this is over and above. This is your long-term capital gains. Over and above your 12.5%, which is over and above 1.25 lakhs. Now, students, comes this 197. Now, students, understand one thing. It has been seen, I'll just give you the background of this amendment so that you are aware of this. Many a point of time, you create a private companies also. You are creating a private companies and all, or many of the companies are they generally have been floated. And it has a huge valuations. And these valuations are not done in one day. like many, it is owning over a period of time. Over a period of time, many assets. And I happen to be the shareholder of that particular private company. And generally, these shareholders are only the promoters. Generally, these shareholders are only the promoter students. And over a period of time, it was being seen. Seen what? That these companies, primarily, they are generally only the promoters. Non-promoters are very few person. Mainly, they are the private companies and all these people, these companies primarily are being held by the promoter, either as an individual or promoter related entities. And there would be some small shares which are been there, which would be held by some other non-promoter person or entities. And over a period of time, it was being observed that even these companies are holding substantial assets. So that the share valuation, when they do, their share valuation, primary students, was at a very high promotion. And I'm telling you, students, do you know which kind of a shareholder? These are the private companies, primarily, whose shareholders were the multinational companies, MNCs, MNC students. So MNCs probably invested many of the companies which were not listed in a stock exchange. Many of the companies are not listed. Many of the companies in this context, like many foreign companies, you will find they are they are in India. They are acting like a private companies. Are you aware of that? They are a private company, students. In this context, like Philips India, even Johnson and Johnson India Private Limited. So you will not find that these companies, all the big multinational companies, shares being probably there on that listed in the stock exchange. They will not do it because they understand that whatever is the valuation, we should be the one who should own the wealth. Their shareholders, you will find, if you see their shareholders, mainly they are the foreign companies, the MNCs. And few shareholders are given like a form of an ESOP. ESOP to whom? To these directors and all. So that they are motivated. And you know how this foreign company wants an exit then? They want these company now to do the buyback. To do what? To do the buyback. And that's how they make an exit from India. These multinationals. So now what happens? These shares are what? They are an unlisted shares. Yes, unlisted. They are not listed in a recognized stock exchange. Now you just imagine the buyback. There is a huge fortune they earn. Earned by whom? Earned by the promoters. So therefore, what the government did for these unlisted and long term, they are all long term people. Huh? They are not. You cannot make a fortune in that day. It's a long term proposition. Now after that, the valuation that the shares hold is of a huge amount. Thousands of crores is the valuation then in that scenario. And therefore, at that stage, the government says that these long term capital gains promoters who have held the shares of these particular private companies, unlisted companies, when their share will be buyback by these unlisted private companies, at that stage, 12.5% and fortune additional tax 9.5%. Can you see that? This is exactly the logic behind it. And that is how students, for the long-term capital gains, for the private company or unlisted companies, do we have the additional tax? Answer is yes. The example which I gave you of these multinational companies which are being there in India. In India, they are registered as a private company. But who are their shareholders? All these multinational MNCs are their shareholders. And that is exactly what the situation is. Now, not only that, just hold on. The thing doesn't stop over here, students. After this, I hope that you have understood this logically, yeah? Because you should understand why the government is in the attack mode by putting the additional tax. The logic, and you have to understand these are the practical things which have happened recently, not that very far. I'm giving some example of 20 years back. These are some recent events that the government have seen. Between like a private company, who were their shareholders? They were checking out. These are the MNCs and all. They made a fortune in this case. They were making an exit through the buyback route. This has become a very popular exit now, students. One exit is you sell the shares, and another exit is through the buyback route. You do the buyback. So the government felt that this particular route, because now they know that they have to pay only 12.5% rate of tax. The government says that this can't be done. And just imagine now, students, how much is the tax rate that it is coming to in this context. If you see, other than company, other than a domestic company, the rate, if you would have noticed, it is 30%. Normal and the for short-term capital gains 20 plus 10, 30 is their target. Just see their target is 30%. Did you realize that? Their target is 30% because that is the base rate of the highest income. Because you are earning fortune, na? What is the highest rate? 30% for the individual. Here also 12.5 and 17.5, 30%. And what about the base rate for the domestic company? Now we are at 22% regime. In this case, remember that section which was there? Are you aware of that? 115 EAB, all that thing you have learned. Alternate tax regime. There's a 22% rate now which is going on for a domestic company in the alternate tax regime. So their thought was 22% for the domestic company. Now just see short-term capital gains. Students, short-term capital gains already at 20. So for a domestic company who are a promoter, plus 2. For the long-term capital gain, which is under 198, 12.5%. Already it is there. Plus 9.5% will make it how much? 22. And 197 also the same thing. 12.5% plus 9.5. It will make this as 22%. 22% is the domestic rate in that alternate tax regime. In the assessment of various entity students, you will learn this particular thing very soon. Did you came to know how to derive these rates now? 22% is the target when base plus additional 22%. When the promoter is a domestic company. And if the promoter is other than the domestic company, then the target is 30%. That is the highest base rate for an individual. That we all are aware. And that is what they are deriving at 20 plus 10 for short-term capital gains, 30. 12.5 plus 17.5. This is how it is. With that, students, now, please have a look to the surcharge part. Surcharge 12%, and there was a CBDT clarification, students, on 23rd March 2026. Very recent clarification. So combined, I have given it together. The flat 12% surcharge applies only to the additional income tax payable by promoters under which section? Under section 69 2B. Okay. By the promoter students. The ordinary capital gains tax continues to bear surcharge, if any, under the normal first this thing. So that's what I was telling you. So does non-promoter, will they suffer the special 12% surcharge merely because they have got the gain on buyback? Merely because I am a non-promoter. Individual from Reliance, buyback is happening. I also earn by capital gains. My chargeability is also under section 69. My base rate is also under section 196, 197, 196 or 198 on this buyback. Question is that, will I suffer the flat surcharge of 12%? No. Why? I am not a promoter. Only for promoter, this is a kill. This is a kill only for a promoter, students, at 12%. Is that point clear to all of you? Non-promoter will not suffer the flat surcharge. So what will be the surcharge in my case? Normal surcharge. If your total income goes more than 50 lakhs, you already know now. 50 lakhs, 1 crore, 2 crore, like that it goes. Then only the surcharge meter will be down. But if it is less than 50 lakhs, no surcharge. But if it is a promoter, and even if for him it is less than 50 lakhs, still whether it is a flat surcharge of 12%, answer is yes. Is that point clear to all of you, students? Everyone? On this LTCG part, students. On this particular LTCG, you will do a flat 12% surcharge. That exactly the point. Is that point clear to all of you, students? If through provisions every one of you are clear, we will do a practical also. Students, I have drafted the practicals for all of you. All these notes, students who are watching in the YouTube, please log in through the portals. All the important heavy, you will find the kind of practical problems, students, have been made for all of you. Including the amendments problems are being made. So those things you will find it, students, over here. So students are advised to log in through the portal. In the portal, these notes are being uploaded. Today, obviously, it will not be there. Radha, Karanya, Lakshmi, Muskan. These notes you will find it. I'll just try to push it for tomorrow. So tomorrow you'll get it. Okay. Comprehensive practical problem, students. Vardhan Technologies Limited, an Indian listed company, undertake a buyback under Section 68 of the Companies Act 2013. Student, this part I'll give you a homework, meaning of promoter and specified security. Please ensure to do this because this Companies Act you are referring 2013. So under Section 16 of the Companies Act. So this is what it is. Specified security. It means of the specified security. Assume the security transaction tax condition for Section 196 and 198 are satisfied. So it's a listed. Fortune are satisfied wherever relevant. The following holders tender shares. Students, holder, who is the holder? A Limited. A Limited, students. Domestic company promoter, Mr. B. Who is the holder? Mr. B. Resident individual promoter. Then Mrs. C. Resident individual non-promoter. D Limited. Domestic company non-promoter. Holding period, students. A Limited is short term, but he is a promoter. Short term promoter. Domestic insurance company, I told you, target is 22%. Domestic company, target is 22%. So, base rate short-term capital gains, 196, 20%. Plus how much? 2%, 22 it has become. Then thereafter you find Mr. B, residential, this is a long-term. Long-term means 12.5. 12.5 would mean, students, plus additional would be base, target is 30, 17.5. In that context. Now for first two promoter, whatever is the capital gains, and therefore the tax that you will pay, whether 12% flat surcharge will it be there? Answer is yes, 12% flat surcharge will also be there. What about C and D? C and D being non-promoter, two things will be there. One is base rate only the tax would be applicable, and the last and most importantly, students, no flat surcharge. Surcharge will be depending upon their total income. Assume the buyback capital gain is the only income of each holder. Obviously, assumption is made. For tax year 26-27, Mr. B, Mrs. C have no other 198 section LTCG. Therefore, compute for each holder, students, capital gains, ordinary income tax on that gain, additional income tax. Students, please be careful. You have to show additional income tax separately. Don't merge the rate and make this as normal rate. No. So when I said you 12.5% plus 17.5% being a promoter other than a domestic company, don't make this as 30% and write tax is 30. No. You have to show additional tax separately. Special surcharge at 12% on the promoter additional tax only. And health and education says, by the way, students, just again, one point I just forgot, or I may not have forgot, I may not have made the emphasis. This 12% surcharge, students, applies only on what? Only on the additional income tax. Can you see this? This flat surcharge of 12% is on the additional income tax. Somebody will ask, sir, what about the normal income tax? On that 20% or 12.5%, which is the normal income tax, on that also, even if I'm a promoter, students, even if I'm a promoter, on that particular this thing, on the normal particular tax of 20% or 12.5%, will there be a flat surcharge of 12? No. So these special provisions are only for the additional tax. Additional tax, additional surcharge. Additional tax, additional surcharge. Please give a header in your notebook. Additional tax, additional surcharge. This go hand in hand. This go what? Hand in hand. What goes hand in hand? Additional tax, additional surcharge. So don't apply this flat surcharge of 12% on the base rate of tax. Even if the assessee is a promoter. For the base rate, base tax, normal surcharge. And normal surcharge is on the basis of your total income. On that basis, the normal surcharge is applied, and that is what it is. So now, students, if you see over here, let's have a look. So A limited, student, directly the calculation is, figures are there. 50 lakhs, 30 lakhs, so capital gain is 20 lakhs. STCG is 196. Ordinary tax, students, is 20% on 4 lakhs. Ordinary tax is how much? 20%. Additional tax, you have to show it separately, 2% of this. 2% of 20 lakhs. Mr. B also is a promoter. 30 lakhs is the LTCG. 198 ordinary taxable base. Ordinary would be 12.5% over and above 1.25 lakhs. So his LTCG is 30 lakhs, but 12.5% would be applied on 28 lakhs 75,000. 28 lakhs 75,000. So 12.5% into 28 lakhs 75,000. This is the ordinary tax. Additional tax, students, would it be on? This is the point. Additional tax, students, will it be over and above 1.25 lakhs? Is additional tax of 12.5% or 17.5%, is it on the LTCG or it is on the LTCG in excess of 1.25 lakhs? That LTCG in excess of 1.25 lakhs is only restricted to what? Only restricted to LTCG, which is calculated under section 198. LTCG, which is calculated under section 198. So LTCG, which is calculated under section 198, on that, which is 12.5%, only on that we have a threshold of 1.25 lakhs, and beyond that threshold, 12.5% is applied. So if it is an additional tax, this additional tax is not under 198. This additional tax is under section 69, subsection 2. And therefore, this additional tax, which is under section 69, will the additional tax of 17.5%, will it be on the excess of 1.25 lakhs or on the entire long-term capital gains? On the entire long-term capital gains, and that is exactly the point. This is what I wanted to show you. This is where people are going to go wrong if they don't follow the practicals. Up to the theoretical point, it was all fine. But the moment you now see the practicals, you now know where you people are going to make a mistake or might be a blunder to that effect. And now if you see Mrs. C, C and D, students, additional tax is nil. Normal tax only is applied. Nothing exciting about it. Nothing exciting, students, about it. Now let's come to the surcharge. Flat surcharge. Let's have a look through surcharge calculation. Very slowly and systematically, students, you have to do and you have to keep revising, students, this kind of questions again and again. In this case, so the module and this particular notes, in the notes you'll find more questions, students, varieties of questions. So as to do, you can do more practice, isn't it? And also a module which is well prepared of the new law. By the way, capital gains module is already up in the Board of Studies website. Now, students, ordinary tax, 4 lakhs. Okay, for A limited. In this context, additional taxes 40,000. That figure we have taken from above. Surcharge, students, 12% surcharge on what? It is for this surcharge, students, is only on the additional tax. I told you, additional tax, additional surcharge. What about the normal surcharge? For normal surcharge, check whether his total income is more than 50 lakhs. And for the company, it has to be more than 1 crore. And the answer is no. So normal surcharge in all the cases happen to be nil in this context. And the additional surcharge on the additional tax amount at flat 12% was to be paid in this regard. And that exactly is the point, students. That exactly the point. So I hope that students A and B only will suffer the additional surcharge on the additional tax. C and D don't have any kind of an additional tax, so therefore there is no question of additional surcharge. This is the real game, and this question, students, covers up your entire particular permutation combination. Did you all got this one? Every one of you. So with that, students, we are done with this one. Congratulations to all of you, students. Is there any query on this one, students? Please ask me right now only. This is a heavy amendment question. And this is something which should be most expected one with the practicals which has been in front of you. Quickly,
So the cess part I didn't got, like upon which amount it is being targeted.
cess on the entire amount. Cess,
Like including the additional tax, no?
just have a look. Cess calculate is 4%. Just do the calculation. No? In this case, ordinary tax is 4 lakhs plus additional tax is 40,000 plus surcharge is 4,800. Just take the total and just on that
Yeah,
keep it up
got it.
4%.
Yes, sir, got it. So
So
surcharge, one thing like I was just trying to remember, like it's only upon the promoters, right? It's not other than promoters.
additional surcharge you're talking about it?
Yes, sir, the surcharge.
Flat surcharge of 12%.
Correct.
That is only for the promoters.
Flat for 12%. Other the normal surcharge is for depending upon the
For
total
all,
income.
that is
That's
for all. That is for even for promoter, non-promoter. That normal surcharge would be for all. Because that normal surcharge, if you see, rather it will be on the ordinary tax amount. That will not be in the additional tax. So the
okay.
normal
Okay.
surcharge, whenever it will be applicable, it will be on the ordinary tax.
Yes. Okay. Got
Okay.
it. Not on
So,
the additional amount in
no,
that.
not will be on additional. So you will have the ordinary tax. Ordinary
Yes.
tax, there will be ordinary surcharge.
Yes.
Okay. Additional tax has got flat surcharge.
Okay, so there is nothing normal. For example, sir, additional surcharge is applicable in total income is exceeding. Then normal surcharge still will be applicable on the ordinary tax, right?
Ordinary tax. Very true.
Okay, sir. One more thing was not clear on the section 71. See that exemption, no withdrawal of the exemption.
Okay.
You said that the asset is being transferred and the shares value has been raised, and then the shares are transferred, right? So, sir, like if the exemption is withdrawn, then like on the shares transfer also we will compute on the year
That is
on which
separate
the exemption was
transaction.
granted.
That is a separate transaction. See, understand that now
Okay.
you are doing two transactions. One
Yes.
is the original transaction when the land was transferred.
Correct.
And second is the another transaction where the shares you are trying to transfer. So there are two distinct transactions. One is for the land which happened say 4 years back, old transaction which is of land. And then there is a new transaction which when the default happened, say 5th year default happened. Wherein what you did, you have sold your shares in that wholly owned subsidiary, say of 20%. So now you are no longer wholly, that company is no longer a wholly owned subsidiary. So is
Hmm.
this share transaction an independent transaction of the real estate transaction in year number one? Yes, both of them are independent to each other. And
Yes.
therefore, for the first transaction for which you claimed an exemption on that real estate transaction, that exemption will get withdrawn primarily. And in the
Yes.
second transaction of the share transfer, in that case, it's a separately completed transaction.
Okay, got it. So ultimately, the cap because now they have lost that wholly owned subsidiary category. That's why this
Exactly.
exemption is getting withdrawn on that point.
True, 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 true.
Yes. Okay, sir. Clear.
Kaniya, Lakshmi, Muskan, you all have any doubts on this? At least on the amendment part specifically, yeah, on that. Can you use the mic, Kaniya, if it is possible, for the query? And Lakshmi also, if it is possible. For the, at least for the buyback part, because buyback, there should not be any confusion. Huh? Buyback is very important. And I hope that you all have appreciated this part. In case of right shares, Kanaya, right share 67, right shares are issued. But then subsequently, I told you about three things: buyback of equity shares, redemption of preference shares, and reduction of share capital. These three things I've told you, isn't it? Any doubt, students, you just let me know straight away. This much.
So that
Yeah.
thing was with regards to the deemed dividend. Earlier, this was charged at IFOs, and
Deemed
now they are
dividend. Yeah, yeah, yeah.
maintaining it as like,
Capital.
what is the logic? Why this is so complicated?
No, not complicated. They have seen the trend. See, deemed dividend, technically, which was being there, mainly what used to happen, the characterization, there are some DTAA implications also. DTAA, what happens is that because of multinational companies, whatever income, if it is in the nature of, say, dividend, then the treaty, there's a treaty which comes, which you learn in module number 4, some DTAA implications which are being there. The government felt that the moment we characterize this as a this thing, as a dividend income, multinational companies majorly, they are in advantage because for them, whatever tax that they pay in India, they have a treaty protection which is available. And by changing the characterization from IFOS or dividend to capital gains, primarily the government has felt that this has given them that lever. Lever of what? Lever of getting the tax in India through the treaty route. This is nothing to do with right now income tax part. I'm just answering about certain things. Ideally, it will be much better appreciated once we actually do that particular area of the. You have some model convention topics, which is in the form of a theory in module number 4. So there you will learn that when it comes to some dividend income or capital gain, some certain important things has happened. You'll also there is a upper limit to the rates of taxes and all for these passive incomes in the form of dividend, royalty, FTS, interest. Those things are there. There are a lot of interplay. Something to do with international transaction has happened, and that is the reason why that was there.
Correct, sir. So, in relation to that, since you talked about the rates, also like why the domestic company and other than domestic companies, there is so much difference of the taxation rates. Like one is 22 and another one is 30.
22 is in the alternate tax regime. Now you will find, in fact,
Yes.
for one company, manufacturing company, the rate is 15%, 1 5.
Yes, yes.
But that is something now, those are the manufacturing distance to the government, primarily the 15%. Generally, if you see the rates, philosophy of the
Yes.
rates, 15%, 22%, these are generally in the alternate tax regime. If you see for individual also, the highest
Yes.
rate in the alternate tax regime is 30%.
Yes.
So, what is the highest rate of a government now in today's time? They are recognizing only alternate tax regime or a default regime. So they have taken that rate, the formulation of this rate has happened from the alternate tax regime. So what for individual, what is the highest rate in the alternate tax regime? 30. For the domestic company, what is the highest rate, the base rate in the alternate tax regime? 22. So they want to ensure that this capital gains does not get treated as the concessional rate. This capital gains tax gets taxed at the highest base rate under the alternate tax regime. At the highest base rate under the alternate tax regime. For the individual, it is 30. For the company, it is 22%. That is the philosophy behind this, the derivation of rate.
Yes, sir. No, I was just asking that, like, domestic company has the lower tax rate, irrespective of the whether it is alternate tax regime or not, and individual suffers a high rate of tax. Like, why this kind of discrimination is happening?
You not say that because company average is 22. The individual, they have got a graded tax scheme. No? They have got a base exemption limits also. Up to 12 lakhs, they will not even pay tax. Do we have this for the company? And the answer is no. Company, whether you are having 10 lakhs, 5 lakhs, 1 lakh rupee, they will have to end up paying tax. So you may say 22%, therefore become what? The base rate. Just Kariya, I will be giving it. The break I'm just giving Kariya now. So this is the average rate. 22% becomes like an average rate for the company. For whom they will have to be what? Indifferent to their total income. It can be rupees 1 or it could be crore. For an individual, though we say 30%, but see how they have reached to 30% primarily. And they have not reached at right from word go. They had a slab rates which was there. Through slab rate mechanism, they could survive. And to 12 lakhs, they don't pay any tax. That exactly is the point. Fine. So they're not
Correct. So
discriminating.
that's what the special relief is being given to individual. That's why they are straight away charging 30% and they are
30%.
recovering the
Ah, yeah.
tax.
True,
Okay,
true.
got the logic, sir. Thank you, sir.
Okay, sure. But I'll take a break, students, quickly now. I think 5 to 10 minutes. Okay, just come back, students, and then we will take the things further because I have to complete this liquidation also and the other parts also. So after the break, students. Sanket ji, 10 minute का break. Maximum. संकेत जी स्टार्ट करें. So students, welcome back. Kanaya, Lakshmi, any queries that you have on this particular part? Now students, just I have told you before the break also, this buyback, I told you under which section it is charged? Section 69. Now, if buyback is charged under section 69, students, you tell me now in this scenario, I'll just give a particular case study and you just tell me the answer for the same. All of you. Over here. And all of you just try to pick up this particular part. Huh? So this is a holding company. This is a wholly owned subsidiary, WOS. What is WOS? Wholly owned subsidiary, 100%. So obviously this is a shareholder of this. The relationship is established. Now what is the scenario, students? Now what is the scenario? The scenario is like this. That so now they are making the payment to holding company on account of the buyback of its shares. Payment has been done, students, by them. Fine. So subsidiary company, now who is the shareholder? 100% shareholder is a holding company. Now the subsidiary company is buying back the shares from the holding company. Subsidiary company is buying back the shares from the holding company. Students, so who is earning the capital gains now? Who is the one who earned the capital gains? Obviously, the capital gains is earned, students, by the holding company. So therefore, the capital gains earned on buyback, is it exempt under section 71? And the answer is, what is the answer, students? Answer is no. What is the reason? This capital gain, students, this capital gain is charged under the section? Is charged under section 69. And the exemption under section 70, students, the exemption under section 70 is applicable, applies only on what? Only on CG charge. Under which section? Under section 67. Under section 67. So CG earned on the buyback. CG earned on the buyback. Is it exempt under section 71? 70 subsection 1? Clause C or D? To that extent, the answer would be no. This capital gain is charged under section 69 and the exemption under section 70 applies only on capital gains which is charged under section 67. Is that point clear to all of your students? This is how the combination could be targeted so far as this examination is concerned. And students, on this there were case laws also. Many earlier case law as old as AAR 2011 judgment, authority of advanced ruling. All these were the judgments in those old case laws and all also, and then latest also. These were something which was being there. So I hope that every one of you are clear now with this proposition. So students, this is what it is. So therefore, Students, by the way, let me ask you, you people have done that PGVP question that was given you as homework. Have you all solved it? See, students, this was the question. The case study which I have just developed to all of you. The case study. Please have a look to this question, students. Parent company limited, an Indian domestic company, holds the whole of the share capital, 100% of share capital of Subtech Private Limited, an unlisted Indian subsidiary. Subtech buys back under Section 68 of the Companies Act a portion of the shares held by the parent company. So there is a buyback done by whom? By Subtech. Okay, so not entire, a portion has been buyback. Subsidiary is buying some portion of the shares which is held by the shareholder, which is the holding company. The shares were held for 10 months. Buyback consideration is 30 lakhs and the cost is 18 lakhs. Examine whether 71C exempt the transaction. Answer is no. It exempts only those which is covered under section 67. Second, whether section 196 applies. If you see, this is a private limited company. It is not listed in the recognized stock exchange. So the capital gains which the parent company is earning is on transfer of the private company shares, which is not listed in the stock exchange. And therefore, this capital gain which is earned will not be subject to the short-term capital gain special rate of 196, but it will be charged at the normal rate applicable to the company, to the domestic company. So that is your second point. Third one, whether promoter additional income tax under section 69 subsection 2, will that be applicable? Yes, if the exemption is not available. Students, what about this thing? Exemption is not available, students. Now the question to all of you is, now the point, students, is that first of all you should understand that this is a private company in this regard, an unlisted Indian subsidiary. It is a short-term capital gain, students. Be careful. I told you that for short-term capital gains, we don't have a additional income tax. Can you see this one, students? So this is a question that is very important being drafted. Everything is covered now. Whatever we have discussed up till now, till the end. Do they get, students, in this particular case now? Promoters additional income tax exemption, is it applicable? And the answer is no. Why? It's a short-term capital gains. Had it been a long-term capital gains and the chargeability was under 197 at 12.5%, then yes, we could have said that this domestic company, which is an SSE and earning the capital gains on buyback, that long-term capital gains tax at 197 would be subject to the additional tax of 17.5%. And on that, there will be additional surcharge, flat 12.5%. But this is short-term capital gains, therefore the answer is no in this context. So this will not be there, students, because this is primarily what? This is in the nature of the STCG. STCG. Is that point clear to all of you, students? With that, students, we are done with the very important particular, the second particular category, which is in respect of the buyback. Now, students, I will be giving you this as a homework. Students, on this would be a homework, students, a simple one, which is one, reduction of share capital. Students, reduction of share capital. This side is your homework. You are capable now, students, by doing this thing, you are capable. Ensure that reduction of share capital. These are some judgments. Okay, and on the basis of judgments only, students, on the basis of judgment only, students, I have made a case study for all of you. I have made a case study, students. I have made a case study. Can you see this? This is what you want to read. I'm not saying that this is a question that you will get in the examination, but you will have a clarity about the thought. Now, I have made you ready to deal with it. I'm not leaving anything wherein you are not ready for it. This you are ready now. Why? I told you where is the charge. Tell me, so the buyback goes under 69. What about redemption of preference shares? What about reduction of share capital? Does the right, my right on that company, does it changes, does it alters on reduction or on the redemption of preference shares? Does it changes? And the answer is yes, it changes, friends. And because that it changes, students, there is a capital gains implication. There is a capital gains implication, and that is what it is. Now you tell me, students, where is the charging section for it? Do we have a special charge? No. The chargeability is under 67 subsection 1. The special charge of 69 is for buyback. 68 is for liquidation. 68 is for liquidation. Now, students, liquidation is what now we are going to hit upon at this stage. Liquidation, students, is what we are going to hit upon at this particular point of time. Let's have a look to liquidation, students, quickly. Liquidation. Now, students, liquidation, if you see, there is a lot of deemed dividend provision also. Liquidation of company. This I have prepared for the very, you will find some entry of liquidation in IFOs also in the form of deemed dividend. That anything which is distributed by a company to its shareholder or at the time of liquidation, even that is considered as dividend. Pay attention, students. Anything which is distributed by the company to its shareholder at the time of liquidation, that amount is considered as a dividend in the hands of the shareholder. So there is a dividend income in the hands of the shareholder. There is also capital gains income in the hands of the shareholder. So therefore, in that context, therefore this liquidation creates a big issue. So many students, what they do is this, that they find it a bit tricky, but it is not the case, students. You just understand the concept properly. As you know, students, liquidation, as the name suggests, this is the final reward that the shareholder is going to get. The final, ultimately, whatever is the amount that they is going to get, that will be the final. So that final, students, is in the form of the dividend. That final is in the form of the capital gains. What I have done, students, is that I have created a stage. Let's see the stage and the issues which are involved in liquidation. Sorry. So company distributes the asset in specie to the shareholder in liquidation. Like in small company, like private companies also, when the private company or unlisted company, they are the one who are there in the liquidation. So if they are the one who are there in the liquidation, then what they do, their asset as it is, what they will do, the asset itself is transferred to the shareholder. And understanding that these transfers are generally done by these unlisted and the small company, whatever are the asset, they just directly surrender to the shareholder. That look, boss, this is the computer, you can take. This is the laptop, you can take as a settlement of your dues. This is how the settlement happens on the liquidations of these private companies or unlisted companies. So section 68 subsection 1 says, what it says? If the distribution itself, distribution of what? The distribution of asset, students. The distribution itself is not regarded as transfer by the company for the purpose of 47. What is distributed? Distribution of the asset in specie to the shareholder. What is in specie? That is in proportion to their shareholding that the distribution is taking place. So if there is a direct transfer of the asset by the company to its shareholder, 68(1) comes into play. So 68(1) is for what, students? Direct transfer. Can I say that? Direct transfer for our revision's sake. So this is the direct transfer of the asset by the company to its shareholder. Shareholder is a transferor. In that case, should we tax that company, a private company, an unlisted company generally, they are the one who do this kind of a direct transfer. Small company at the time of liquidation, and the answer is no. And the answer is no. So this capital gain, students, is not being taxable in the hands of the company. But if supposedly like a big company, what happens, students? You know, for a big company, generally they appoint a liquidator because there is a huge assets which are there of these particular companies. And if there are huge assets, so what the liquidator has to settle the dues of the shareholders. So what the liquidator, students, is going to do would be that liquidator, students, company will first sell an asset to an outsider and then it will distribute the cash thereafter. Can you see that? Liquidator company will first sell an asset to an outsider and then distribute what? The cash thereafter. That is what they do. Na? They will sell the company's asset outside and whatever is the cash, now the cash is what is going to be distributed. What has happened in the first case? Direct asset transfer has taken place in the first case. So over here, if you see students over here, what they say what students over here? That now you tell me students and logically you tell me whether the capital gains in this particular case, will it be taxable or not? Logically you tell me students, capital gains in this particular case, will it be taxable or not? Yes, in the hands of the company, yes. Because the company has sold it outside and therefore the company has sold the asset outside, then this capital gain which is sold by the company outside is taxable. So there is no exemption that is applicable to the company, unlike in the first case. First case is direct transfer of the asset to whom? To the shareholders. Direct transfer to whom? To the shareholders. So therefore, students, can you see this? The outside sale is taxable transfer by the company. Section 68(1), where the exemption was sought earlier, does not protect an antecedent sale, means a previous sale. Previous sale means the sale to the outsider. Merely because of proceed, just because whatever the amount that I sold, I got the money, and that money I ultimately given, the money I ultimately gave it to whom? To the shareholder. That cannot be the defense for getting the exemption. To get the exemption, there is only one defense. And what is the defense? Direct transfer of the asset should have taken place to whom? To the shareholder. This is what, students, is a taxation in the hands of the company. This is a taxation, students, in the hands of the company. Now comes, students, the taxation, students, in the hands of the shareholder. Now comes the taxation, students, in the hands of the shareholder. Now, students, what I will do is that I will make a chart for all of you in this particular context. And if it is possible, you also make a chart, students, in this case. All of you students. So over here, shareholder. Now, any shareholder who is there, say for example, in this case. So just have a look. Just a second. You can just write this one on liquidation, students. On liquidation. Now we will just have on the left hand side, liquidation left hand side, we'll be putting it for the company. And on the right hand side, we'll put it for the shareholder. Okay. Now students, have a look over here. First, the capital gains issue. First, the dividend issue. Now, dividend, students, over here, you have to just see the total asset. Say, for example, the total asset of the company is, say, the total asset is, say, 100, and the accumulated profit of the company. So this is a dividend issue, students. The accumulated profit of the company is, say, rupees 40. Is, say, rupees 40. Now this is 40 rupees only, students, accumulated profit. Now you tell me how much will be the deemed dividend. Now, one thing, students, you should know. Now asset is 100, but your accumulated profit is 40. Students, first a dividend section comes into picture under section 2 clause 40, what we discussed. They say that any distribution made by the company, any distribution, whether it is of cash or if it is of an asset, whatever it is, any distribution which has been made by the company to its shareholder at the time of the liquidation, then that distribution will be considered as deemed dividend, but only to the extent of the accumulated profit possessed by the company. Only to the extent of what? Only to the extent of the accumulated profit of the company. Only to that extent, this will be considered as the deemed dividend. Now, therefore, the total asset which is distributed, whether it is cash, money, non-money, it is total is 100. Accumulated profit of the company, students, is how much? 40. So therefore, students, what is that particular thing? Therefore, the deemed dividend would be how much, students? Therefore, the deemed dividend. Under section 2 clause 40, I suppose. Just a second. Let me see from the section. 240C. So 2 clause 40. How much is the deemed dividend? It is how much? To the extent of the accumulated profit, which is 40. Which is 40. Okay, so this is what it is, students, in this context. So deemed dividend is only to the extent of 40. Because only to the extent, that much only dividend is out of the profit in this context. So therefore, to the extent of the accumulated profit, 40, this is the dividend. Now, say for example, the shareholder, one of the shareholders is Mr. A. Now, this shareholder, Mr. A, is 10% shareholder. So, if this Mr. A is a 10% shareholder, how much he has received? He has received 10. Total proportionate right he has received. And out of 10 students, out of 10 rupees, 4 will be dividend charge. Under which head? Charge under IFOs. Charge under the head IFOs. In the answer of the shareholder, Mr. A. This is what it is, students, at the end of the day. Isn't it? Now comes the next issue, which is the capital gains. Now comes to the next issue, which is the capital gains. So after dividend, we are writing over here, students, the CG. Now CG, students, I told you already. As far as the company is concerned, students, they have 168(1) protection available. But that 68(1) protection for the company, that direct transfer, direct asset transfer to shareholder, exempt. Okay. However, 67(1). However, if asset sold first and then what, students? Distribution take place. Then the distribution take place. Then what happens, students? After that, the distribution is taking place. Then what happens? Then the charge under section 67(1) will be attracted. No exemption. Students, no exemption for the company. You all agree? No exemption to the company under section 68(1). Now comes, students, the big one. For the shareholder, what will happen? Now, shareholder should understand. For the shareholder, he was a shareholder. He had a cost of shares in his hands. Students, he has what? He has a cost of shares in his hand. And the answer is yes. So he is receiving as a shareholder. No? He is receiving what? As a shareholder in that case. So for the shareholder, Mr. A, what he has received? Money, amount received, or fair market value of the asset. Whatever he has received, fair market value of the asset received. By whom? By the shareholder. How much he has received? In my example, 10%, so 10 in all. 100, 10% was this much. Now, out of this amount, how much portion was already taxed under the head IFOs? From this amount, how much was already taxed under the head IFOs? Under the IFOs, as a deemed dividend, under section 222C, sorry, under section 240C, how much was tax? Already 4 is tax. So 4 is tax already under the IFRS. So the balance is what is chargeable as a full value of consideration, FVC. So this balance 6, full value of consideration, students, is what? Is taxable under section 62 in the hands of the shareholder. 6 is the FVC. Now say cost of the shares. Cost of shares by X. By A is, say, whatever be the amount, I don't know, say rupees 5. I just take an example. Just I'm taking an example. Example, it is 5. Okay. So therefore, capital gains is 1. This is how he will calculate his capital gains. This is how he will calculate his capital gains. Is that point clear to all of you students? Just focus on this one once again, and any query that you have, you please ask me on this one once. Let's first just copy down everything. This is the capital gains implication. Left hand side is the company, right hand side is the shareholder. All of you.
So if it is accumulated loss, then there would be the no question of deemed dividend.
Yeah, if supposingly the question is that if supposingly instead of accumulated profit, if there is no profit at all, so the question of deemed dividend will not arise. So there is no IFO's chargeability then. And if there is no IFO's chargeability, then entire amount received would be charged under the head capital gains 62. The entire amount received will go there under section 62. So this would be the full value consideration. Clear?
Yes, sir, clear.
Kanaya? Actually. Kanaya? No repayment. So all of you are clear with this one, Ruth? So this is what it is, students, in this regard. I hope that every one of you are now clear with this one. So now, students, in this case, there is a question. Now, say for example, I'll ask you one question, students. Let me see how many of you can answer this. Supposing, students, what this Mr. A has received, pay attention, students, be very careful. And let me see if you can answer this. It will be really a brilliant interpretation, students, on here. So it is maybe a bit, I'm stepping up my question one step further. Although such level of questions comes once in a 10 years or so, but still let me ask if you can. Supposingly Mr. A has received an asset of that rupees 10. Okay. No cash, he has received an asset and the fair market value of the asset was 10. Now, of which 4 was already considered as deemed dividend of section 2 clause 40. Subclause C. 4 was already considered as deemed dividend. And the balance 6 which has been there, is taxable under the head capital gains as a full value of consideration. Now that asset which is there, students, that asset which is there is now transferred outside. So once he received that asset from the company, subsequently he is transferring the asset. So on the subsequent transfer of the asset by Mr. A, subsequent transfer of the asset by Mr. A, students. Now you please tell me the selling price would be the full value of consideration of that particular asset. What would be the cost of that asset, students? This is what I would need to know from all of you. That of that asset which he received on liquidation, he primarily has sold that asset after some time. So when he will sell the asset after some time, so he will be subject to capital gains. Selling price, whatever he get the money is the full value of consideration. My question is, what is the cost of acquisition then for him? What is the cost of acquisition of that asset which he received from the liquidation? Quickly, students, only 30 seconds time. That is that you all are getting it. It's an advanced question. I understand that, and that's the reason I'm limiting the time to 30 seconds. If you can answer, well and good. Even if you don't answer, still well and good. No issues at all. But just at least you can try, no? That way, let's see. Your brains at the end can go to the next level.
Sir, I think it is FVC which was there on the date as on the existence under
Yeah.
68.
And the amount is how much?
Amount is 6 only, sir.
Okay.
Because the sale price would be differing now when he would be subsequently transferring.
Subsequently, he is selling maybe, I'll say, see, subsequently he would have sold, say, rupees 15 rupees. I'll just give an example. So subsequently, he has sold, say, for rupees 15, 1 5. Which asset? The asset that he has received from liquidation. 15 rupees is his selling price. So obviously, he has to have some cost. No? What is his cost? What is the question? Kadaya, Lakshmi, what is the cost? Quickly, students. And the cost is, answer is 10 rupees, students. And why is it so? Because please be careful. Please be careful. Why 10 rupees I am taking? Because, students, up to rupees 10. Think logically. Up to rupees 10, he has already suffered tax on that asset. Up to rupees 10, he has already suffered tax on that asset. 4 rupees in IFOS and balance 6 rupees in capital gains. So therefore, what should be his cost? What should be his cost now? Rupees 10. If you take rupees 6, then your gain will be higher, and to the extent of at least rupees 4, the higher gain to the extent of rupees 4 will be subject to a double taxation. Will be subject to a double taxation, and hence, in order to avoid a double taxation, your cost should be how much? To the extent of the amount which has already suffered tax earlier. It doesn't matter under which head, but did it already suffer the tax? Yes. How much he has already suffered the tax? To the extent of rupees 10. 4 in IFRS, 6 in capital gains. And therefore, you will write on subsequent transfer. Continue further over here. On subsequent transfer, please write. I'll dictate to all of you. I hope that all of you have understood this particular proposition, that why this particular FMB is taken. On subsequent transfer of, I'll dictate you, you will keep writing. On subsequent transfer of the asset received, the asset received on liquidation, the asset received on liquidation, the cost of the asset the cost of the asset will be the fair market value, at the time of liquidation. In the bracket, right? What is FMB? In this case, FMB, so it is not FVC under 682, it is FMB of the asset. You people have said FVC, which is 6. It is not FVC, it is FMB, which is 10. In the bracket, you can write 10. FMB, which is equal to 10. Right? You can write one more sentence if you want. This 10 as the cost. This 10 as a cost is essentially to avoid double taxation. Essentially to avoid double taxation. This is not something new, students, you are learning, by the way. This is the principle you already have learned in the previous class only. I'll tell you. Conversion of capital asset into stock and trade, students. Just recall the conversion of capital asset into stock and trade. The capital asset cost was 100. At the time of conversion, the fair market value is 125. So on 125, you calculate the capital gains. The fair market value at the time of the conversion, which is 125, you took that. And from that, you reduced the cost, which is 100. And therefore, you got the capital gains of rupees 25. That is your CG. Then there is a sale of the stock, subsequent transfer of the stock. And how much is the subsequent transfer of the stock? 175. Subsequent transfer was how much? 175. Now you tell me that will be business income. Now, business income, what is the cost that you're going to take in computing a business income? What is the cost? Will you take 100 or you will take 125? You will take 125. You will not take 100. Why? Because you know up to 125, the charge is attracted under the head capital gains. Up to 125, the charge is already attracted under the head capital gains. So therefore, what is left for PGBP is 125 is the cost for PGBP. Selling price 175, cost is 125. If you take for PGBP cost 100, then what happens? Double taxation to the extent of 25. Same thing happens over here also. I hope that every one of you are clear with this one. All of you. Kishan, Radha, Lakshmi. Perfect. So I hope that this is the point, students, that you should be very clear about this kind of thing, that why we are taking this as the FMB. So there is a question, students, if you see over here in this particular context. So the question has already been there in this regard. And students, if you see very quickly in this context, one question, this is also there in your module. So this is a module question, students, which you have taken. So just have a look to this particular question, students, quickly. So this is point, students, already in this context. Please have a look. This is the Aries tube. That is towards the end of the module, you will have this particular question, students. This particular part. So Aries Tubes Private Limited goes into liquidation on 1st of June 2026. Immediately before liquidation, its share capital is rupees 5 lakhs and accumulated profit are rupees 3 lakhs in this context. So students, up to 3 lakhs would be the deemed dividend under 240C. During realization of assets in liquidation, an additional profit of 5 lakhs has arisen. There are 5 equal shareholders, each of whom had acquired his shares of 1 lakh and receives 2,60,000 in the final settlement. Students, 2,60,000 in the final settlement. So therefore, students, if you see over here, so each of them, students, has got 2,60,000 students in the final settlement, isn't it? Now, in that, how much is that dividend, students? You have to first remove that. Now, if you see the dividend portion, for the company level, 3 lakh is the dividend. Total divide by 5. So, everyone, how much is the dividend? For everyone, how much is the dividend? Divide by 5. So, in that case, 60,000. So, out of the total amount received on liquidation of 2,60,000, 60,000 will go as a dividend. Under 240C, that will be separately charged in the hands of each shareholder under the head IFOs. And the balance 2 lakhs then will be the full value of consideration for capital gains purpose. So 2 lakhs would be reduced by cost of shares, which is 1 lakh. So therefore, capital gains is how much, students? 1 lakh per share. I hope that all of you are clear with this one. I hope that all of you are clear with this one. And now, students, this asset which has been received, the asset, students. Now see, just another question, students. One more question. See, here, one more question. Subsequent here. So the same thing. What was my question? What should be the cost on the subsequent transfer? Students, on the subsequent transfer, what will be the cost? The cost should be rupees 10. How much by 10 in my example? 4 was charged in IFOs and the balance 6 is charged under the capital gains. So therefore, the cost will become 10. Please have a look to this particular case. On liquidation of Alpha Limited on 30th of September 2026, shareholder M receives land having FMB of rupees 80 lakhs. So I have received the land whose FMB was 80 lakhs. Now, students, you know, out of this 80 lakhs, some portion will go to deemed dividend and some portion will go to capital gains out of this 80 lakhs. No? And subsequently, if I sell the land, when I sell the land, what will be the cost? Cost will be 80 lakhs. Do you all agree? That is what it is. The value of that land is included in M section 68(2) capital gains computation. So, which means, like rather you said, na, if there is a loss, accumulated loss, then there is no dividend. And if there is no dividend, then entire amount that you have received will be your full value of consideration for capital gains purpose. So, therefore, it is capital gains computation. Alpha Limited had acquired the land for rupees 20 lakhs and held it since 2018. The company you are talking about it. M sells the land on 31st December 2026 for rupees 92 lakhs. Determine the cost. I told you the cost would be 80 lakhs and the broad capital gains result on subsequent sale. Now, students, the question therefore is here. This part, this I'll discuss it in the next class, but nevertheless, the question that we are trying to talk about over here is this, that whether the period of holding, the main part is that, be careful, friends. The shareholder M has received, when M has received? M has received on liquidation, which is September 2026. When M has received on 2026. And when he has sold on 2027. Less than 24 months. So you may say, sir, it is a short-term capital gains or short-term capital asset. Question to all of you is whether the period of holding of the previous owner will that be clubbed in determining the nature of capital asset in the hands of Mr. M. Who is the previous owner? Previous owner is the company. Remember, students, one thing. This discussion I will have it to you in the next class. I will not torture you right now at this point of time on this concept. But this I just wanted to put a query in your mind. Whether this would be a short term or it would be a long term. Whether this will be short term or long term. In the next class, students, we are starting with amalgamation, demerger, conversion, and slump sale. This is the next class agenda. So, students, at that particular point of time, the very first thing I'm going to take you through to the clubbing, these clubbing of holding of the previous owners. Whether those clubbing of period of holding of the previous owner, will that have to be done or not? That needs to be tested, students. That we will do. Now, students, just a second over here, reduction of share capital. In this case. Now, students, if you see, I told you the reduction of share capital. In this case, whether the reduction of share capital, whether that reduction of share capital will that be considered as a deemed dividend, that is the first thing I am determining it, and therefore, students, section 240D includes within dividend any distribution to shareholder by a company on reduction of its capital. So when the capital of the company reduces and when the company distributes the amount, then that reduction to the extent to which the company possesses accumulated profits. To the extent to which the company possesses what? Accumulated profit. So any distribution that the company does to the shareholder for what? To reduce its capital to the extent of its accumulated profit, that would be considered as dividend. That would be considered as dividend. So a company making a payment to shareholder, it is viewed from the angle of dividend first. And therefore, even this reduction of share capital, students, reduction of share capital on account of reduction, if the company gives any payment, that will be viewed as what? As a dividend. So safe, but again to the extent of accumulated profit. So let me ask you the same question, students. If supposingly the company has company is reducing the share capital from 10 to 5 and it has distributed an asset of say rupees 6. Say of rupees 6. Company has distributed the asset of say rupees 6. Okay. Accumulated profit of the company was only rupees 2. Accumulated profit of the company was only rupees 2. So tell me how much is the dividend? 6 is what has been distributed. Out of 6, how much is dividend? Only rupees 2. And balance 4 will be what? Towards the capital gain charge. Balance 4 will go towards the capital gain charge, and that's exactly what happens. So therefore, this was to be done back to back. 220, students, 240C and 240D. Always remember this two things, two case. And therefore should be done always together. The way I have taken you through, and that's the reason why this is a homework. Now you understood this particular proposition. Again, I would want, if supposing you want to, since it is in the YouTube, this is the benefit. This example, you can just again take it back and just have a look to this example. And after just hearing this example, then you will see this particular page. So that this can be done. Now this you are capable. That's the reason why I wanted to discuss this particular deemed dividend of 240D with all of you. So that you can relate, yeah, these are similar. What we learned in 240C, similar as 240D. And the balance is towards what? Balance is towards the full value of consideration for this one. With that, students, I hope that all of you are clear with this one. Every one of you. Fine, students. Priya, Radha.
Sir, one query that you were discussing about Aries tubes, now in that accumulated loss, because the land was transferred, so where it is the question of accumulated loss, that's what I was pondering upon.
Accumulated loss? There
Yeah,
was
yeah.
profit, no?
The
Aries tube does
80
not
lakhs
lose that.
wala sum, sir. 80 lakhs fair market value land had been acquired by Alpha at 20 lakhs something you were discussing, na? That was
Yeah.
not clear.
And the second question after Aries tubes, the next question after that.
Correct, correct.
80 lakhs. So therefore, what was that? They have not given you the figure of that. See, they have not given the figure of that particular thing. Because if they would have given, see, any case, the question was what? What is the fair market value? Supposingly there is an accumulated profit. So portion will go under the head IFOS as a dividend and portion will go under the head capital gains, portion will go under the head IFRS, portion will go under the head dividend, under the head capital gains. The way we have discussed about that 10 rupees, 4 went to dividend, 6 went to capital gains. And then when I sold subsequently, how much is my cost? Cost was 10. Okay, that question which you are referring to, that question does not have any accumulated profit information. They were only talking about what will be his cost on the subsequent transfer. What they told was that the fair market value of the asset distributed is 55 lakhs or 80 lakhs. So what is the question that has to, so out of this, what would be the possible in that 80 lakhs? Some portion can be dividend, balance portion would be for capital gains, or entire portion would be for capital gains if there is a loss. But one thing will be the constant, the cost subsequently would be 80 lakhs only, because the entire 80 lakhs would have been charged earlier. Some portion as a dividend, some portion as a capital gains.
Yes, sir. I'm getting your point that at that FMV 80 lakhs has to be taken as cost. That was the main crux of the question.
Yeah, correct. And so the point is that why it has been costly, because 80 lakhs, the entire game is what? On that 80 lakhs. They were, see, 10, when I said you 10, 4 went for dividend and 6 went for what? For capital gains. Isn't it? Now that 4 was dependent on what? On that accumulated profit.
Correct.
Supposing the company never had any accumulated profit in that question,
Okay.
then what would have happened? No dividend.
Yes, no dividend. Then what actual asset was being received?
Entire 10 would have been capital gain charge.
Correct.
And if entire 10 would have been the capital gain charge, on the subsequent transfer, 10 would have been my cost.
Cost, yes.
That will always remain the same.
Correct.
So if supposing in this question also they have not given anything about accumulated profit. So say for example, they would have given accumulated profit as 30 lakhs, say for example. Then to the extent of 30, it will go to IFOs.
Yes.
And the balance 50 will go to capital gains.
Correct.
But subsequent transfer, my cost will be 80 only.
Correct.
50 plus 30 so as to avoid double taxation.
Correct.
So that 80 will remain constant.
Yes.
Isn't it? That exactly.
Like I was thinking about what this income tax provision is actually indicating. It is limiting to accumulated profits. What would be the reason? Because it is limited profits. That's why.
No, accumulated profit only for dividend. The first charge is dividend. When the relationship between a company and the shareholder, they always view from the lens of dividend first.
Okay.
That's the reason why dividend is getting a precedence.
Correct. I got it.
Exactly why they are viewing from the lens of dividend first, and then they are coming to the capital gains. This is a hierarchy of what we have learned today.
Right, sir. Sir, another query, like actually you had told me to remind you at the end of the session, the difference of the 2 clause 109 of transference.
That maybe next class, I think 9:50, the next session, you just remind me again. One of the sessions I'll take it, don't worry. One of the session this week, either Thursday or Saturday. One of the two will happen, don't worry, for sure.
Okay, sir. Thank you,
The
sir.
clause part that you're talking about.
Yes, sir. The clause and sections, like why this kind of thing is earlier it was not there, no, sir. So that's why.
No, today would maybe next class you ask me, I'll tell you, because I think this 240C and that section 68, 61 and all, I think will make sense. Do remind me next class. Definitely, I'll shoot it in the next class for you.
Okay, sir. Sure, sir.
So students, do ensure to go through that reduction of share capital, case study, case law, and both. Even if you read only case law now and the section, you can forget that practical which has been given to you. It's still fine. That case of Karthikeya, Supreme Court, Sarabai, is a very landmark judgment. Please go through that. So next class, students, is our amalgamation, demerger, slump sale, and the related other provision. This is target for the next class. Fine, students?
Yes, sir, I agree to this point, but actually, your notes are not uploaded even today. Also, I just contacted, so that is the issue, sir. Like how to refer.
This only part. What I say, the last lecture, in any case, was basic. So capital gains, you can just refer from the definition thing.
Yes, sir, that is fine. But right now, the notes.
This part I will ensure to. Maybe by tomorrow, I'll just try to push it to do that.
Yes, sir. Please do that, na. That's the thing. Nothing else, sir. Thank you, sir. Take care.
Okay.
Bye.
Good night.